Hello everyone, welcome to today's US Open live webinar. It is Thursday, December 14th, 10 minutes before Wall Street opens as usual. I'm your host, Nikos Dabouras, Senior Financial Editorial Writer at FXCM. This is a super central bank's super week, as we already talked about, and the Fed kicked things off yesterday, offering a dovish outlook, which of course sent Wall Street and the bond markets higher. The Bank of England picked up the baton today, standing pat, but keeping more tightening in play, and did not discuss rate cuts, while its European counterpart also stayed on the sideline, hinting again at peak rates, but also not discussing rate cuts, while President Lagarde's press conference is still ongoing, so more things could come out of that. And of course, next week on Tuesday, we expect the Bank of Japan in another potentially key decision. That's what we will be discussing about today. As always, before we begin, please read carefully through the risk warnings and the disclaimers. Okay, let's get the ball rolling. We're going to start with the Fed and the NAS 100 reaction, the Nasdaq 100, then move to the Bank of England and the reaction of GBP USD, and then turn to the European Central Bank and Euro USD. We will then round things off with the Bank of Japan, which announces its policy decision on Tuesday. So the Fed kept rates at 5.5% as expected and lowered its 2024 median rate to 4.6% from 5.1 previously, implying at least 3 rate cuts or 90 basis points worth. Chair Powell in his press conference did not push back against market pricing, which is much more aggressive. And in fact, expectations were bolstered after the outcome, with CMEs assigning the highest probability to rates falling to 3.75 to 4% rates by the end of next year, meaning 150 to 175 basis points of cuts. As a result, Wall Street, the bond market rallied, and Wall Street also rallied, with the Dow hitting new record highs. Nasdaq was also boosted and is on the verge of such highs, which you can see on the chart at 16,770, trying for a strong finish to a blockbuster year. On the other hand, there is a huge gap between what markets anticipate in terms of rate cuts and what the Fed projects, and this creates risk of disappointment. Furthermore, policymakers did not take more hikes off the table, even though that was not depicted in the dot plot, but in any case, the dot plot is not policy. It's not mandatory to follow it. Chair Powell acknowledged that inflation is still too high, warning that officials still have a ways to go, and said that declaring victory would be premature. And as we have said, other than that, the economy is very strong, and the job market is still tight despite coming into better balance. Now, the NAS 100 is in overbought levels technically, and as such, there is scope for a pullback towards 16,178, the next major support, but strong catalyst would be needed for moves beyond that, and for the EMA 200 exponential moving average to come under question, the black line that you see on the bottom of the chart at around 15,770. Now let's turn to the Bank of England, which stood pat for third straight meeting at 5.25%, but once again 3 of the 9 members dissented in favor of hiking rates. It kept more tightening in play if necessary, but updated the reference around next move, saying that the committee continues to judge that monetary policy is likely to need to be restrictive for an extended period of time, which to me seems a bit softer than the previous one, the previous relevant passage. However, the minutes showed that the decision was finally balanced, which is a bit of a hawky sign, and it did not officials did not discuss prospect of rate cuts, while repeating the fact that their projections are conditioned on rates staying at around current levels until Q4 2023. So essentially, they shut the door to any rate cuts anytime soon. The rate differential is definitely favorable for the pair, as the Bank of England has much more ground to cover on inflation than its US peer, and it's stepped away from any rate cut talks. As such, GBP USD benefits and actually clinches higher highs. You can see here the November highs, it touches those with an eye on 1.28825, but we are a bit cautious around further advance. On the other hand, any more hikes could plunge the UK economy into a recession, which has been avoided. So that theme may not be able to drive the pair much higher, and there is a risk for renewed pressure, but strong catalyst will be needed for daily close below the 200 period EMA at around 1.25. Now let's turn our attentions to Euro USD. Let me remind you that President Lagarde is still on the podium, so it's still an ongoing development. The European Central Bank hinted once again at peak rates, having it maintained for second straight meeting rates at current levels, and once again hinted at peak rates, but repeated that current levels maintained for sufficiently long duration can help restore price stability. And remember, we talked about the previous in previous sessions how there was a fast deceleration in inflation. They expect it to pick up again temporarily in the near term. It lowered, however, its 2024 CPI projections to 2.7%. The Fed is more optimistic, seeing the PCE not the same figure, so any comparisons are tentative because of this difference, but sees them lower to 2.4%, and it discussed prospects of lowering cuts, and it hinted at lower rates, and it hinted at cuts. It signaled rate cuts via the updated projections, whereas the ECB did not. In general, I would say the ECB was definitely the more dovish of the two. Up until we start this live webinar, the President Lagarde had a rather reserved approach and said that they did not discuss, that officials did not discuss rate cuts. And this helps Euro USD, which rose after Wednesday's dovish Fed outcome and stays on the front foot today, after having defended the key 38.2% FIBO. This creates scope for higher highs, but we're cautious around the ascending prospects. The November highs are located at 1.0996. Now, despite this round of decisions being more dovish on the Fed side, the ECB has made more progress on inflation. Remember, it was 2.5% in November, according to preliminary data, while the Fed is still above 3%, and its economy is suffering while the US economy outperforms, and this puts it at a better position for rate cuts than its US counterpart. As such, there is risk of a return below the critical 38.2% Fibonacci and the 200-period EMA at around 1.0799. But the downside appears well protected for now, and fresh catalyst would be needed for more losses. The outlook here is a bit muddy as things stand now. Based on today's decisions, it is in favor of the pair, but with the ECB having made more progress on inflation and the economy in a bad shape, I would say it's ahead than its US counterpart for cuts, although market expectations appear to me exaggerated in both cases. And now let's round things off with what's ahead. It's the Bank of Japan that stands out on Tuesday. It maintains an ultra loose policy stance with negative rates and yield curve control, in stark contrast with its major peers, and of course, most importantly, the Fed, and that's why the pair has rallied again this year. The BoJ, however, has been taking steps towards normalization, loosening its grip on the yield curve, and has hinted towards an eventual exit from the negative rates. Recent comments from Governor Ueda bolstered markets' expectations for a shift and essentially made next week's decision live, at least in the eyes of the market, and that's why you have been seeing this drop that you see on the chart over recent days. But officials don't seem to be in a hurry, although the central bank has made surprise moves before. We have talked about that again in the past. Normalization from the BoJ as the Fed prepares to cut rates, points to lower rates, has the potential to lead to a massive repricing in USD JPY. So that's it from me for today. We will talk again on Tuesday, 10 minutes before Wall Street opens, as always.